Now, in the past hour, the US Federal Reserve has increased interest rates for only the third time since 2006, but the second time in 3 months. The central bank raised the Fed funds rate, what banks charge each other for short-term loans, to a range of 0.75% to 1%. That represents a quarter-point increase from the last upwards move in December. Lucy Carroll is the chief economist at Aberdeen Asset Management. She joins us now live from Edinburgh. Lucy, I guess this would be more of a surprise if the Fed hadn't moved.
Yes, it certainly would. It would have been an enormous surprise. I think everybody had expected this to happen today. The question really was, what would the Fed then be signalling about future rate rises this year and into 2018?
Yeah, I mean, what did you make of the accompanying commentary? I mean, it looks like we're going to get at least 2 more interest rate rises this year and probably gradual increases over the next few as well.
Yes, the guidance we're being given is 2 more rate rises this year and then another 3 in 2018, and that's very clear. They also talked about the prospects for inflation and said that the outlook for inflation is pretty stable. They're not terribly worried about that. They're pretty bullish on growth and on employment, but overall it was a fairly measured, gradualist message.
Yeah, no real surprises. In fact, the dollar has actually slipped since this decision came out. Do you think in the back of their mind the Federal Reserve are worried about pumping up the dollar too much with more hawkish rate increases?
Possibly, but I mean, it's very hard to predict how currencies will react to statements from central banks. So I think that they were themselves really more focused on what they viewed as the outlook for inflation and the risks around their forecasts. And they seem to have gone today for a very measured process. They don't seem to be terribly worried about the inflationary risks in the US economy. So I think it was a very measured and a reassuring message. And as you say, the dollar fell and the equity market, the stock market in the United States seemed to like it. It rose quite sharply on the news.
Is there a case, though, Lucy? I mean, inflation is still relatively benign in the United States at the moment, despite them having a jobless rate of just 4.7%. Has the rate at which unemployment can fall to without generating higher inflation come down? I mean, this is a big debating point on both sides of the Atlantic, isn't it?
Yes, you're absolutely right. Both in the United States and in the United Kingdom, central banks are looking at the current jobless rates and seeing that actually wage growth remains very subdued, even though the unemployment rate has fallen both in America and over here in the UK to very low levels. They're pretty puzzled about that. They don't really know what the answer is, but it does seem as if that sort of jobless low rate, the rate at which wage growth kicks in, is quite a bit lower than we had thought only a few years ago.
You mentioned the equity markets just now, Lucy. This is fantastic news for the banking sector. I mean, this will really pump up banking profits, won't it, in the States?
Well, I think we don't want to over-egg it. It's probably a good thing for the banking sector that rates are on a gradually increasing path and that they are set to rise further because that sort of benefits banks. But rates are still at pretty low levels. I think there's just a general relief that the world's biggest economy, the United States, is starting to normalise interest rates. It's a sign that one country at least is feeling a bit more normal after this very long legacy period from the global financial crisis.
As you say, the Fed has obviously taken the view that the US economy has turned a corner. Here in the UK and in the Eurozone, of course, interest rates still at ultra-low levels. Which of the world's major central banks do you think will be next to start tightening monetary policy?
Well, actually, there is one other major central bank that is currently more in tightening mode, and that's the central bank in China. But if we sort of put that to one side as well and we start to look at the UK and the Eurozone, it seems as if interest rates, both here and for the European Central Bank, are going to stay at ultra-low levels for at least another year. There isn't any sign really yet that they're starting to turn their attention seriously to increasing interest rates. So I think for now, as far as the developed economy is concerned, it's still going to be a US-led story.
And briefly, Lucy, the Fed statement referred to business investment picking up in the United States. We could do with a bit of that here, couldn't we?
Well, business investment is always a good thing. And yes, at the moment, what we seem to have seen in the United Kingdom is that there has been a bit of a pause on business investment. It hasn't been picking up. Perhaps this is Brexit related. Companies waiting to find out more about what life is like post the triggering of Article 50 before they decide to undertake any expensive investment plans. So the pause still seems to be in place here, whereas in the United States there's more confidence that business investment is finally taking off.